Danny and I met working on disruption strategies in the media industry, and what became very clear was that an industry that was already in the sort of spiral down into disruption, it was too late to really do anything useful. So we were looking at where, as an industry that has a longer runway before disruption is likely to bite. That was when we decided to start approaching financial services companies.
I think what caught people by surprise is it's a very sophisticated way to approach corporate venture capital, to actually partner with somebody to allow them to operate autonomously and independently, but work incredibly closely and deeply in a partnered sense together.
We actually did chat to a couple of banks, but Brian really got the thesis and the idea of this kind of approach as a bit of an insurance policy or a hedge against disruption.
I think we were the first sector-specific venture capital fund and the first fund to call out FinTech and data as a material and new sector of the economy.
Looking at FinTech now, it's kind of unmissable as one of the, probably the major theme of innovation in the startup space. When we started back in 2014, FinTech was barely a word in Australia.
So we've gone from no companies to 30 companies in the portfolio, just the two of us originally, to now a team of 10. We've definitely gone deeper on our thesis around data. We think that data is a material part of the changing nature of financial services, and I think that's really come home to roost with consumer data right and open banking. And more recently, we've expanded our remit to look at what's happening in Asia and some of the emerging FinTech opportunities in those markets, which are evolving in a different way to the Australian market.
Does Afterpay and Zip replace the bank over time? I think that's pretty questionable still. They're still very small companies relative to the banks. So when we think about those sorts of businesses, where we actually think they become more disruptive is in places like India, where we've just made an investment in effectively the Zip of India, which is Zest. I think worrying about these kind of new players is not necessarily something the banks are going to benefit from. I think there's definitely opportunities to learn from these new players. And I think there's actually a fantastic engine room of innovation that some of these new players have created. I think the big disruptions are still coming down the pipes. The big disruptions are most likely from large global digital players who see financial services as just another revenue stream. And they might be Chinese players, they might be the Googles, Facebooks, etc. of the world. So as those disruptions start to come down the pipe, that's when having a really strong set of alternative adjacencies to step into could be powerful.
So looking forward to the next 5 years, a big focus for us as evolving venture capital manager is to help our successful companies really gain success and get to that point where they scale materially, have a material impact on the economy, on the strategy, perhaps on the bank, and then find those successful exits for those companies as they become standalone operating entities in their own right. And then secondly, it's continue to work with the bank on establishing what I'd call a regular cadence of investment. So as we get some of those exits and return the capital, what's our strategy for collectively recycling the capital through ongoing fund structures, so we kind of get to this mature state of investing in a portfolio of capability which is accessible to the bank to utilise. Our thesis is always that half of the things that we invest in would be successful and half would not. That's our kind of success measure across a portfolio of companies, and when you look at Fund 1, it's definitely more than half of those companies are looking incredibly promising. We've benchmarked ourselves relative to funds at similar stage, bearing in mind we're only 5 years old, and kind of peak returns are kind of generally years 8 to 10 in any fund of our kind of life cycle. And benchmarking those returns to date see us in the top quartile of global funds. Fund 2, Fund 3, too early to tell.
A big bank obviously has a ton of resources, and there's a lot of ventures who are keen to try and access those resources, those capabilities. So, I think that does provide an advantage. It's probably a challenge, actually most in those areas where the people think they're going direct for the bank's revenue stream. Those players are probably at times a little bit wary about having a bank as an investor, even through a third party. So I think the arm's length nature of the fund is helpful, but not always sufficient to make us the first investment of choice for somebody who's going direct for the bank as a attempting to disrupt them. So it's been interesting from a disruption versus sustaining point of view.
The pros and cons of having Westpac as a major investment partner. Well, credibility in our domains is a huge one. There aren't many deals in FinTech or cybersecurity or data that don't make its way to us. That's hugely positive. Access to subject matter expertise inside the bank. Our ability to assess the cybersecurity company Casada due to the capability in Simon Brown's ISG group. We would not have been able to make those determinations on our own. Thirdly, where we can get the interests aligned between our venture and Westpac, it's quite powerful in terms of the opportunities that can create for our portfolio companies. I think the cons are, there's a handful of us behind me here and 45,000 people at the bank. It can take a lot of time. It can take a lot of time and it can be God's work. Engaging with a large corporation very much focused on the today and here and now issues and trying to paint a picture and spark imaginations about what might be possible 5 to 7 years from now. Do we have an anti-portfolio, which is what you call it in venture capital, of the ones that got away? Some like Bright that we passed on because our belief was it was a sustaining innovation for the bank. We did have the thesis for Afterpay and Zip right at the beginning, but missed both of those opportunities because they both had listed by the time that we were actually up and investing. Both of those companies, were beyond our investment mandate once they were public companies. Yeah, so there's always a couple of those, and they're the ones that make you reflect on, what you do differently tomorrow. How do you make sure you don't miss the next one?